Ever wondered how companies make crucial financial decisions? Ever heard about financial modeling? This seemingly complicated term might sound like a maze of numbers and jargon, but it's actually a critical tool that helps businesses make informed financial choices. It's the linchpin that connects assumptions, projections, and formulas to deliver insightful forecasts. Used extensively across various industries, financial modeling is a robust practice, aiding in evaluating business strategies, investment opportunities, and financial health. Now, this might sound a bit overwhelming, but we're here to simplify it. In the next few minutes, we'll take you on a journey. Starting from the basics of financial modeling, we'll explore its crucial components, delve into the different types, and understand its paramount importance in strategic decision-making. Additionally, we'll share some handy tips and best practices to make your financial modeling journey smoother. So, are you ready to unravel the complexities of financial modeling? Buckle up. Financial modeling might sound intimidating, but it's a fundamental tool in the financial world. So what is it? Well, in simple terms, financial modeling is like a virtual representation of a company or a financial asset. It's a mathematical model that represents the performance of a financial asset or portfolio of a business, project, or any other investment. Think of it as a weather forecast, but for finance. Just as meteorologists use models to predict weather patterns, financial analysts use financial modeling to anticipate and plan for future financial performance. Now, why is it important? Financial modeling plays a crucial role in various sectors. In finance and investment, it aids in decision-making, helping analysts evaluate potential investments. In real estate, it's used to analyze property investments. Even startups use financial models to attract investors. Now that you've got a basic understanding, let's dive deeper into the components of financial modeling. Just like building a house, financial modeling requires certain building blocks. Now let's dive into these essential components of financial modeling: assumptions, projections, and formulas. The first building block is assumptions. These are the bedrock of your financial model, and they set the stage for everything that follows. Assumptions can include factors such as future sales growth, inflation rates, or cost of capital. It's important to note that while assumptions are inherently speculative, they should always be based on thorough research and sound reasoning. Next, we have projections. These are the anticipated financial results based on your assumptions. Projections typically include elements like profit and loss accounts, balance sheets, and cash flow statements. Remember, the key here is to be realistic and not overly optimistic. Your projections should reflect possible future scenarios, not just the best-case ones. The final component is formulas. These are the mathematical relationships that tie everything together. Formulas in financial modeling can range from simple additions and subtractions to more complex calculations, such as discounted cash flows or net present value. The brilliance of formulas is that they allow your model to automatically update and adapt when you tweak your assumptions or projections. Now let's talk about the role of Excel in all of this. Excel is a powerful tool that has become synonymous with financial modeling. Its grid of cells, each capable of holding a value or formula, makes it the perfect platform for building complex financial models. Key Excel functions that you'll often use include sum, average, NPV, net present value, and IRR, internal rate of return. Mastering these functions can significantly enhance your financial modeling skills. In essence, assumptions guide your projections, projections inform your formulas, and formulas bring everything together in a cohesive model. And Excel? Well, it's the canvas where all these components come to life. With these building blocks, you can create diverse types of financial models. The beauty of financial modeling lies in its flexibility and adaptability. It's not a one-size-fits-all tool, but a versatile instrument that you can tailor to fit your specific needs and scenarios. Financial models come in different shapes and sizes, each serving a unique purpose. They're like the tools in a financial analyst's toolkit, each one designed to perform a specific task. Let's dive into some of the most common types. Firstly, we have the discounted cash flow, or DCF models. These are the heavy lifters of the financial modeling world, used to estimate the value of an investment based on its expected future cash flows. Imagine you're a venture capitalist trying to determine the value of a promising startup, or a real estate developer calculating the potential returns on a new project. In these instances, a DCF model could be your go-to tool. Next up, we have three-statement models. These are the workhorses of financial modeling, integrating the income statement, balance sheet, and cash flow statement into a single comprehensive model. If you're a financial analyst at a corporation, you might use a three-statement model to forecast future performance or to analyze the potential impact of a new business strategy. Finally, we have scenario models. These are the chameleons of the financial modeling world, adaptable and flexible. They allow us to explore different what-if scenarios by adjusting various input parameters. Let's say you're an economist trying to predict the impact of a policy change, or a portfolio manager assessing the risk of different investment strategies. In these cases, a scenario model could provide the insights you need. But remember, financial models aren't one-size-fits-all. The right model to use will depend on the specific situation, the data available, and the questions you're trying to answer. And while these are some of the most common types, there's a whole universe of financial models out there, each with its own strengths and weaknesses. Knowing these types is only half the battle. Understanding their impact on decision-making completes the picture. Scene script. Financial models are more than just numbers on a spreadsheet. They can shape a company's future. Imagine you're in a ship navigating through a stormy sea. Would you prefer to have a map and a compass, or just rely on your gut feeling? Financial modeling is that map and compass for businesses. It helps guide strategic decision-making, steering companies towards their goals while avoiding potential pitfalls. Accurate financial models are invaluable tools for decision-making, shaping the course of a company's future. They provide a detailed view of a company's financial health, enabling businesses to make informed decisions. Whether it's about investing in a new venture, launching a product, or even deciding on potential cost-cutting measures, financial models offer the data-driven insights necessary to make these decisions confidently. Let's paint this with a real-world example. Consider a tech startup looking to launch a new product. By leveraging financial modeling, they can predict the product's profitability based on various scenarios. They can assess how changes in market conditions or production costs may impact their bottom line. With these insights, the startup can decide whether to push forward with the launch or pivot to a different strategy. Or take the example of a large corporation planning a merger or acquisition. A comprehensive financial model can help analyze the target company's value and the potential return on investment. This enables the corporation to negotiate a fair price and make strategic decisions that could save or earn them millions of dollars. These examples underscore the power of financial modeling in decision-making. It's not just about crunching numbers, it's about using those numbers to tell a story, predict the future, and make strategic decisions that could make or break a company. So, it's clear that financial modeling plays a pivotal role in decision-making. But how can you make this process more efficient? Mastering financial modeling requires practice, precision, and a few handy tips. So, let's dive into some efficiency tips that could help streamline your financial modeling process. First and foremost, familiarize yourself with the essential Excel functions. They're your best friends in this journey. Functions like VLOOKUP, index, and match can save you a lot of time when handling large datasets. Next, consider using a modular approach in building your model. Break it down into distinct sections such as input, processing, and output. This way you can easily update or modify one part without disrupting the entire model. Let's not forget the power of automation. Macros can automate repetitive tasks, and conditional formatting can highlight key figures or trends at a glance. Remember, the goal is not just to work hard, but to work smart. Now let's talk about data accuracy. It's crucial to validate your data input. Always double-check your sources and ensure the data is up to date. After all, a model built on faulty data is like a house built on sand. It won't stand for long. Regularly updating your model is equally important. Financial markets are dynamic, and your model should reflect that dynamism. Don't let your model become a relic of the past by neglecting regular updates. Also, always have a plan B. Prepare for different scenarios by creating alternative versions of your model. It's better to have and not need than to need and not have. Lastly, don't forget to document your work. It might seem like a tedious task, But trust me, when you revisit your model after a while, you'll thank yourself for it. Clear documentation also makes it easier for others to understand your model. In the end, financial modeling is more of an art than a science. It requires a blend of analytical skills, creativity, and a keen understanding of the financial landscape. Remember, accuracy and efficiency are the keys to effective financial modeling. Financial modeling might seem like a mountain, but with the right approach, you can conquer it. Let's recap our journey. We started with the basics, understanding that financial modeling is a critical tool in various industries, helping us make informed decisions by predicting future financial performance. We then delved into the building blocks of financial modeling, highlighting the importance of assumptions, projections, and formulas. Equally important are the Excel functions that make the modeling process efficient and effective. Next, we explored the common types of financial models, such as DCF, three-statement, and scenario models, each with its unique applications. We underlined the significant role these models play in strategic decision-making, showcasing their real-world impact. Lastly, we shared some tips and best practices to streamline the process and ensure data accuracy. Remember, practice is the key to perfection. So keep exploring, keep learning, and you'll soon master the art of financial modeling. That wraps up our deep dive into financial modeling. We appreciate your time and hope you found the journey enlightening. Don't forget to like, share, and subscribe for more insightful content. Next up, we're tackling risk management in finance. Until next time, keep crunching those numbers and shaping the financial future.